Remember the revenue recognition principle from back in Module 1 or 2 where we talked about this, various principles and assumptions. Revenue recognition principle states that we recognize revenue when the product or service is delivered to our customer. So when the work is done is when we record it as revenue, whether we get paid for it or not. The matching principle, which is now called the expense recognition principle, says that we should record expenses in the same accounting period as the revenues that are earned as the result of those expenses. So if it costs you something to make something or sell something or do something, you should record that cost, that expense, at the same time that you record the revenue, so that you're matching it against that revenue, because remember, revenues minus expenses gives you your net income. And this matching is a major part of the adjusting process. This slide shows you the framework for adjustments. There are 4 of them. In reality, they talk about 2 accruals and deferrals. The top 2 are the deferrals, where cash is paid or received before the expense or the revenue is recognized, so you have the deferred expenses and deferred revenues. And the bottom one that you can't see behind me are accruals, and we will get to those in another set of slides. Let's talk about prepaid expenses. Prepaid or deferred expenses, we paid for them before we got the actual benefit of that expense. So when you think about supplies or think about prepaid insurance, where you paid the money and you recorded it in an asset account, either supplies or prepaid insurance, you debited that account. Now you're saying, okay, we've used up some of those supplies or the insurance has expired, so we want to call that an expense. And when we're increasing an expense, we do it on the debit side. We're going to credit the asset account to show that that's been used up and is now being reduced. This is also in your book. This is a little need-to-know example, and you can go through it. I'm sorry, it's not in your book, it's in the slides. The 3-step process for adjusting the prepaid account. Determine what the current balance actually is. So if you're looking at supplies, you would say, I started out with 50 pencils, I go in and look and I have 10 left. So how many did I use? I used 40. That's what the current balance should be 10. And so we're going to record an adjusting entry to get to from step 1 to step 2. So the first one is prepaid insurance, shows that $1,000 remains. With the prepaid rent, on October 1st, prepaid $12,000 for a year. On December 31st, how much rent would have been used up? October, November, and December's. Supplies, again, we'll look at this one, and then depreciation we'll talk about in a minute. For the prepaid insurance account, has a $5,000 debit balance to start the year. They tell you there's $1,000 left. So if you had $5,000 here on the debit side, what the current balance should be is $1,000. You have to credit that for $4,000 to make it be $1,000 here, correct? This one shows you the prepaid rent account. I just said that you used up 3 months worth, so that would be $3,000. You want your balance to be $9,000. Debit your rent expense, credit your prepaid rent. That's your adjusting entry that you need to do. Debit the expense, that goes to the income statement. Credit the asset, which you can't see behind me, and that goes to your balance sheet. Supplies account, we're going to do the same thing with. Depreciation is its own animal. Depreciation is a little bit different than the others. Depreciation is going to be calculated based on how long the asset will be in use. We're going to see more of this in Chapter 10, but for now, you're only going to use straight line depreciation. Right now, they tell you it had an estimated life of 10 years, expects to be valued at $8,000 at the end of the 10 years. So you're going to take $38,000, and they show you that here. Subtract the $8,000. That's what it's going to be worth at the end. Divide it by 10, and you get $3,000. That would be your yearly depreciation. Two accounts are always used for depreciation. The first is depreciation expense, and the second is a contra asset account called accumulated depreciation. You will always debit the expense and credit the accumulated depreciation, not the asset itself. Let's look at unearned or deferred revenues. Cash is received in advance of providing the products or services. So you pay someone in advance to do something. Say I pay somebody $1,000 at the beginning of the winter and say, come plow my driveway, which is the terrible driveway, every time it snows. They got paid in advance for doing work later on. So we would have recorded that as unearned revenue. When the work is actually done then, when they come and plow my driveway, we want to debit the liability and credit the revenue account. That's the adjustment that has to be made there. Again, we're going to see what they call a need to know, and we have three separate accounts here, three separate cases that's going to ask you to adjust the unearned revenue liability account. Unearned rent revenue and unearned services revenue. So let's look at each one. Company collected $24,000 rent in advance on September 1st, debiting cash, crediting unearned revenue. The tenant was paying 12 months rent in advance, and occupancy began September 1st. So that would be September, October, November, and December that they would have used up. So that would be $2,000 a month. Should have 8 months left, or $16,000 worth. Used up 4 months, that would be $8,000. So debit your unearned rent to reduce the liability and credit rent revenue. That rent revenue has now been earned. In this case, company charges $100 a month to spray a house for insects. Customer paid $600. Excuse me. In November, in advance for 6 treatments, recorded this with a debit to cash, credit to unearned services revenue. Company has applied 2 treatments. So if it was $100 a month for 6 months, and yes, they would have used up $200 worth and have $400 left. Debit the revenue, unearned revenue, and credit the revenue account. It's now been earned. And those are your 4 deferrals, or your 2 deferrals.